Geopolitical tensions in the Middle East remain elevated as markets navigate fragile ceasefire dynamics alongside rising energy prices. Oil is consolidating near the $100 per barrel mark again this morning, feeding renewed inflation concerns across the globe just as developed market yields edge higher and economic data points at slowing economic activity. Equities, meanwhile, are fragmented. Software stocks came under renewed pressure yesterday after disappointment from IBM announcements raised concerns about AI disruption, while semiconductor names continue to outperform their peers on sustained AI-driven demand. Intel's strong results after the bell highlighted renewed momentum in data center and CPU demand. So welcome to Swissquote's Daily Market Talk. It's Friday, April 24th. I'm İpek Özkardeşkaya, and we will cover a lot of topics again today. But before we do, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
So geopolitical tensions remain elevated. The ceasefire holds right now, but it is fragile. The US Navy reportedly boarded a supertanker carrying Iranian oil in the Indian Ocean, while US President Donald Trump ordered American forces to shoot boats placing mines in the Strait of Hormuz. Iran, on the other hand, frustrated by Donald Trump's blockade and public bashing, is not willing to come to a negotiation table. So oil prices consolidate near the $100 per barrel level this morning as developed market yields are rising, along with oil prices that fuel inflation expectations around the world, and equities are hesitant near their all-time high levels. Indeed, the PMI numbers yesterday came to confirm the negative impact of soaring energy prices on economic activity across the globe. The numbers yesterday show that the European services were particularly hit by soaring energy prices. So the euro-dollar returned below its 100-day moving average and is testing the 200-day moving average to the downside presently. A broadly stronger US dollar also weighs on the global FX complex, with the dollar index testing its own 50-day moving average to the upside as geopolitical tensions remain high into the weekend and rising oil prices increase demand for the US dollars. As such, the rally across global equity indices stalled yesterday. The Stoxx 600 index closed the session flat, while the S&P 500 retreated from an all-time high level. A sharp sell-off across software stocks also added to the worries yesterday after results or announcements from IBM failed to reassure investors that the cohabitation with AI will be smooth. They indeed highlighted slowing software growth instead and didn't upgrade guidance, reinforcing doubts among investors about the sector's momentum and revived fears that AI is indeed disrupting traditional software models. So investors sold the whole sector, not just IBM. iShares expanded technology software ETF tanked more than 5% in yesterday's trading session. So that sell-off also feeds into worries about the private credit, remember, tied to the software company. So in short, the software demons were back in yesterday's trading session. On the flip side of this trade, though, the AI enablers continue to extend their gains. Chip stocks gained again, with VanEck Semiconductor ETF hitting a fresh all-time high level yesterday as appetite for AI investment and AI enablers returns gently these days. Intel earnings after the bell put a cherry on top of the story because the company announced better than expected earnings last quarter and better than expected guidance as well, as demand for data center chips to power the massive AI expansion lifted its flagship Xeon server processors. Intel has been unable to market a GPU to compete with rivals like Nvidia and AMD, but they are very, very strong in terms of CPUs. And guess what? The CPU demand is soaring today. As companies build out AI systems, they need a lot of these CPUs to run everything around the GPUs. Nvidia had also launched CPU on its own earlier this year, remember, to capture that demand, the great CPU. So Intel is in a good place right now with the CPU business. Plus, Intel has a foundry business as well that is waiting to fulfill orders, remember, and the US government's backing to bring production back to America is certainly helping. And if it makes any difference, Elon Musk said he would use Intel technology to build his in-house chip manufacturing plant, so improving fortunes for Intel thanks to a renewed focus in what they're good at making. The CPUs sent the shares 20% higher in the after-hours trading, and we will likely see Intel benefit more from the renewed CPU demand and the global chip shortage. What a turn of events. Across the Pacific Ocean, Korean SK Hynix, which is a memory chip maker, echoed a similar story. Their profit jumped fivefold to over 25 billion US dollars last quarter, while revenue tripled past the 35 billion US dollar mark. That's more than half of what Nvidia announced the quarter before and tripled Intel's revenue. So it is indeed a big number. But SK Hynix investors were not necessarily impressed with these numbers, not as much as Intel investors, as the surge in revenue has been priced in. The stock is indeed up by nearly 700% since this time last year. And the surge is partly due to the fact that we are now in a memory chip boom cycle that SK Hynix expect to last for another 3 years. But after that, if history is any guidance, there will be plenty of chips in the market and we will enter the bust cycle and the revenue would drop. Now, there is a possibility that AI helps memory chip makers break that cycle. But what's more realistic is that AI demand will make the boom cycle longer, but not keep the sector in the boom phase forever. So profit taking on blockbuster SK Hynix results are on the menu this morning in South Korea following earnings as a sign that it may be time for a certain downside correction and consolidation for the memory chip makers after a relentless rally since last year. Elsewhere, TSMC in Taiwan also soared to an all-time high level this morning as the nation's financial regulator lifted the cap on single stock holdings, and China's DeepSeek launched a preview of his highly anticipated new model called the V4 model, sending Chinese chipmaker stocks up as well. In this context, Hua Hong in Hong Kong rallied more than 17% this morning, while Cambricon gained more than 5% and SMIC gained 2.80%. Alibaba, on the other hand, which considers investing in DeepSeek along with Tencent, also gained today. As such, the Hang Seng Index rebounded from an early dip in Hong Kong today, and the technology-heavy Nasdaq futures outperformed their US and European peers this morning at the time I am talking here. Now, geopolitical uncertainties will likely keep appetite strong in technology names that are more resilient to these tensions as investors continue to feel uncomfortable getting exposure to industries that are shaken by the war and rising energy prices and the negative implication of this war for global growth. In commodities, gold, which has remained quite muted faced with the Middle East war, remains unloved by investors as the US dollar serves as a better hedge today for the actual oil price boosted inflationary environment. Price of an ounce slipped below its 100-day moving average this week as the US dollar strengthened. And we could see a further downside pressure in the yellow metals price on the back of stronger US dollar and rising US yields, both negative for gold appetite. But price retreats in gold are actually great opportunities for long-term investors to buy the dips, because gold remains in this positive trend globally as central banks and other institutions are now replacing their US Treasury holdings by the precious metals on the back of the uncertainty regarding their relationship with the US. That said, the dip, however, could be at a distant $4,100 to $4,250 range for gold, including the 200-day moving average and a March dip. So no rush yet. So this is all for this week, guys. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a safe weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.